Yeah, so this is awesome. So we're making a podcast. So obviously, to make a podcast, you got to record the podcast. Hi there, everyone. My name is Preet Sandhu, and I'm a partner here at Gallo LLP. What we're going to be doing now is coffee chats, and what we're going to do is bring different guests on to talk about their businesses, what's happening out there, and just kind of have a good conversation. Today, our first guest is Stephen Maholick. I actually know your name. It's a tough last name to pronounce. Stephen, why don't you kind of give us a little bit of lay of the land of what you do?
Sure. So I'm an investment advisor with RBC Domain Securities. I specialize in working with clients who have maybe a little bit of complex financial situations, and they're really interested in growing their wealth. So what are some tax strategies? What are some advantages? What are some things that they may or may not be aware of? So as an investment advisor, my role is portfolio management. So how do we manage the investments? How do we grow it in a time efficient and high value kind of approach? But really starting to incorporate a lot of different planning strategies that can really add direct benefit to what they are right now in their business cycle, and then years later into the future as well too. So I love pairing up with great accountants and great firms who understand that benefit of, if we start early, we start with a solid plan, we engage tax strategies, the potential for life savings is truly altering as well too.
Awesome. Thank you so much. It looks like you said that before. So as I was mentioned before, this is going to be a different kind of podcast. We're going to be talking about unique stories. Like to talk about some stuff that's happening this weekend.
Sure.
Something happening on Sunday. It seems like
I think there's a big game happening on Sunday.
Big game is hockey.
No,
hockey. Yeah, no. Obviously, it's a Super Bowl weekend coming up, so you got to start with that. Who do you think is going to win this one?
I really like Cincinnati, but I think the Rams are going to win.
Yeah, you know what? If I was a betting man, I'd probably take Rams as well, but I hope Cincinnati wins for sure.
You're going to bet on the game, aren't you?
Yeah, I'm going to bet. Yeah, so that's definitely. What's your kind of like the bet that might win but might not win?
I really like really odd stuff, and the Super Bowl is such a fun event because there's so much other stuff happening between the halftime shows or the commercials. But random stuff like betting on the anthem, how long the singer or the anthem is going to be. It's a random bet. My friends and I have been doing it for the last 10 years. Nice. And this is the dumbest thing to bet on, but betting on how long the anthem is going to go.
That's a good one, actually. Yeah. I might do that one. But I think if anyone needs one that might happen, I have a feeling there's going to be a safety this one.
Okay.
Just have a one. It's 50-1 odds for that one. So yeah, let's get started. So we're going to be talking about IPPs today. So I'm going to be sharing my screen. So, okay. So we should be, you should be seeing that. So I'll let you go from your seat.
Sure. So again, thanks for having me. Again, I'm excited to talk to you guys about individual pension plans. It's something that I feel can add a lot of value to business owners, and they may or may not be aware of it. So I wanted to go over today, how does it work? What are some benefits? And a couple case studies that could be applicable to where you are right now in your current financial journey. So quick disclaimer again, before you make any decisions, talk to your advisors, talk to your accountant to confirm if this makes sense. Again, this is for information purposes. So I thought the agenda then quickly just touch upon wealth management and then dive head into individual pension plans and have a question period at the end. So again, the approach that we take here at RBC here is a really comprehensive approach. We really want to understand where you are right now in your personal and your business financial goals and provide that comprehensive analysis here. So at whatever stage you are within your life cycles, whether you're growing your wealth, trying to protect it or transfer it into income stream or to your legacy as well too, we're going to surround you with experts in their individual fields so you're getting the best possible advice. This is also a nice little propaganda we always like to tell people here. Just kind of highlights all the different experts at our disposal internal. So again, as an investment advisor, I focus on portfolio management, the financial planning, how does it incorporate with your overall tax planning strategies. Again, our team also has access to our credit and lending departments, our estate and trust services, charitable giving, and also an insurance license too, which insurance as part of a wealth planning strategy is something that's really misunderstood and underutilized as well too. So That's everything that we have in-house. But then we pair this with external advice, external advisors like Gallo as an accounting firm, or like a law office or an actuary or anyone else, or business consultants, to really add value to your wealth. So take that comprehensive approach and then again, introduce you to strategies you might not be aware of. So the first question and why we're here today is talking about business owners and how they plan to save for retirement. So typically when I ask a business owner, what are your strategies? How do you plan to retire? I usually get one of these three kind of responses. Either A, I'm going to sell my business. Okay, who are you selling your business to? Well, maybe it's going to be my child, my kid, maybe a business partner, or maybe I just listed open market for sale. I'll ask, well, what if you don't get the price that you want, or can't sell your business at a certain time frame that you want? What are your other backup options? What's your plan B? So a lot of people say, well, maybe I'll purchase real estate. I want to buy commercial property. I want rental properties. I want rental income that will support me throughout my retirement. Okay, well, what if we go through a pandemic and you have to lower your rent, or you don't get any rental income, or you're tying up all your wealth into one commercial property here in Edmonton or surrounding areas? What happens if that doesn't go smoothly? Do you have any other backups or liquid savings that you might have? Typically, people will say, well, maybe I'll buy an RSP, a registered retirement savings plan. It's something that's very common. A lot of people understand and know about, but if you are a business owner, there's a better strategy than an IRSP, and that's individual pension plan. So you can have one or more of these kind of common answers, but if you're incorporating RSPs, I would say you should stop as a business owner and explore the benefits of these individual pension plans. So what is an individual pension plan, or IPP? I think the best way to describe it is that it essentially is a supercharged RSP for business owners and incorporated professionals. So if you have a PC, a professional corporations, these work. So basically, it's an RSP inside your business. So you can contribute inside your business. You can get tax deductions for your contributions to your business income, and it's going to be there and grow tax sheltered within your business. Preet is excited about clicking. So I would say that it's there inside your business. So instead of taking money out of your business, paying marginal taxes at your marginal tax rate to make it RSP contributions, we avoid that step completely, and we keep the contributions inside your business. Now, that's some tax benefits that hopefully Preet can probably clarify as well too. But in terms of the benefit with the plan itself, is that you're able to contribute more on an annual basis into the IPP as opposed to an RSP. So you can contribute more. You can contribute more as a tax efficient with using corporate income, and it's going to allow your investments to grow even faster and in tax sheltered. As well, these things have grown in popularity since 2016. There were some major tax rule changes that happened in 2016, such as the tax on split income, and then also the small business deduction grind with passive income taxations. So these have grown in popularity and in need since tax rules have changed. So again, these plans are a great way to shelter money, to mitigate some risk, and to reduce your corporate tax rates as well too right now. So who are some ideal owners of an IPP? Who should think about doing this? So certain criteria. Number one, you need to be declaring T4 income. So T4 income or employment income, you're paying yourself from your business. So you're paying yourself from your business here, not as a dividend, as a T5, but a T4. Now, I've worked with some clients who were declaring T5 income. We opened the IPP and we just changed it for the future years. So we just amended it to T4. That's going to determine your contribution limits. Now, ideally as well, you're over the age of 38 to 71. That's when this formula kicks in that really start to add benefits. So just like an RSP, the IPP can stay open until you're 71 to make contributions. But after 71, the plan actually closes and you have to start taking money out of the plan. Again, criteria, you have to be the owner of the business. You could include your spouse if they're on the business, maybe as a non-voting shareholder, or they're just incorporated as part of that have some shares of the business, they can be included into the IPP as long as they're the owner of the business as well. And lastly, if you do have tax issues, you're concerned about passive incomes, you're trying to find more ways to reduce your corporate tax rate right now and get some refunds here, this can help. Now, I should say too, the IPPs, they cannot be set up at a branch level or a self-directed account. You need to go through a wealth professional. And the reason for that is the registrations. We actually have to use a third-party actuary to register the account, to set up the accounts as an ongoing reporting issues with the CRA and with the Alberta pension plans as well too. So that's why you can't set these up yourself at a local branch or through a self-directed account. There has to be some coordinations between these parties. So what are the benefits of the IPP and how they can help you right now? There's 4 different benefits, and I'm going to go quickly through these 4, and then I'll show you some case studies of how it actually works. So first and foremost, the contributions. So annually, you're going to be able to contribute more into an individual pension plan as opposed to the RSP based upon the formula that's given to us from the CRA. So with the help of the actuary, we're going to determine your contribution limits based upon your T4 stated income. If you're getting the maximum contribution amount of an IPP, means you need to be taking out of your business $162,000 per year. If you take out less, your contributions are going to be a little bit less. But when we compare the max contributions from an IPP to an RSP, you can see how there is an advantage. And this number keeps growing as you get older. So the way this works is that you're going to be able to shelter more inside a registered savings plan that's tax sheltered at a higher contribution amount than you would ever have inside an RSP. So the advantage is just you're going to be able to save more. Second thing, we can do something called a past service contribution. So when we open up your IPP, basically what we would do a look back and say, okay, how long have you been in business for? When did you incorporate? Have you been taking out T4 income for the last few years? When we open up the IPP for the first time, we're actually going to find out what that value of that pension plan should be worth if you had been open up the account prior to that. So when you open up the account, we can do a lump sum initial one-time contribution for a large amount of money. So if you have cash sitting within your corporate account, you can contribute that in, get a nice tax deduction hit, or you could actually pull your RSPs over into the IPP as part of this past service. And I'll explain why you might want to consider that as well too. But just know when we open an account, there could be a one-time lump sum contribution that could be quite large. This is optional, but it's there for you if you want. And I see some people have some questions. We'll get to questions in a little bit. So probably just hold off on that a little bit. And the final, there's a couple more fundings, but one of the final ones can be really helpful. It's called terminal funding. So when you retire or you sell your business, so the last year that you kind of close the operating account of your business, we will actually, again, calculate how much that account should be worth. And is there options to make a one-time lump sum final contributions? This can be really impactful if you sell your business and you're going to be getting a large windfall of cash. But now you're going to get exposed to additional marginal taxes, corporate taxes, capital gain taxes, and you're trying to find ways to shelter some of those that income that you earned from the sale of your business. Well, if you had an IPP opened, we can look at a terminal funding amount and determine, can we add money in at the very end of the account? I'll give some case studies of how this works as well. Finally, from a risk mitigation standpoint, again, the IPP assets are creditor protected. So if we open up an account, you start contributing into it and your business becomes bankrupt, as an example, or you're getting sued, the assets held within the pension plan are protected. They're not able to be pulled out. and part of a settlement agreement. Those are your protected assets. I put a little asterisk next to that litigation part because it's saying that if you're in the middle of a lawsuit right now and you're thinking, I'm going to try to hide some money, open the account, well, that's not going to pass the smell test of the lawyer. So we're going to try to pull that back. But if you just have been operating this for a few years now, your business starts to go through some tough times, just know that these investment assets are protected. And also your contributions into the plan are optional on an annual basis. So if for some reason it's the pandemic, our cash flow of the business slowed down, we will actually every 3 years calculate a top up. That's an optional amount that you can add past contributions into the account at a future date as well too. So just know that there are options. You don't have to put in money every single year. And again, the investments that you hold within the account, again, it can be whatever you want. It's diversified. We can add whatever investment accounts, whatever portfolio stocks you can possibly buy, we can hold into it. There are no limitations on that. And again, these plans have been around for over 30 years. It's been kind of one of those planning tools that we've had in our kind of tool shed. We didn't really have to pull out since 2016 when there's been some tax rule changes that cause a need for this to reevaluate this. So how can this help your current corporate tax income and current tax deductions? Well, your contributions that you're making into this plan on an annual basis can be utilized against your current annual income earned within your business. And of course, there's that past service, so that one-time setup, the top up or the terminal funding. All those contributions that you're making into this plan can be written off towards your corporate taxes. As well, the fees. So there is an actuary fee. It's about $2,000 to set up the account and about $1,000 per year. Those actuary fees, you have to have that for the reporting and for the CRA and the pension plans. It's a requirement. You need to have this reporting done. Those actuary fees can be deducted against your corporate income. And also the advisor fee. So who's managing the money in the accounts can be written off. This is why if you had RSPs, your RSP management fees cannot be written off. This is why if you had RSPs, you can pull it over into your IPP, and now you can start to deduct your advisor fees, your expenses as a tax deduction towards your corporation. And finally, for estate planning, this is something that, again, if you do really long-term financial planning, can really help out mitigate taxes at death of parents. So I'll go through an example on this later, but if there's a child attached to the business, as an example, they can be added as an owner of an IPP. Now, this is great because this can completely bypass estate taxes and probate when we're having owners' names change on the registered account. So basically, if you had RSPs as an example, you pass away, all those RSPs have to get pushed out and then given to the beneficiary. But when that happens, that final year of the estate, when you pass away, something called a deemed disposition will happen. And what will end up occurring is that all those assets are subject to whatever marginal tax rate or state tax rate you're at. So if you had RSPs for say over $1 million, everyone passes away. Well, now your estate could be looking at a tax bill around $200,000-300,000, yeah, or so. So if this was incorporated as part of an IPP strategy, that $200,000-300,000 taxes will not be payable. There's no tax disposition. So a couple case studies. So first and foremost, I thought I would just talk about a medical professional. Say they're 55, they've been around for the last 10 years, they're making that T4 max income of $162,000 per year, and they've already had some savings in an RSP. So here's how the contribution comparison can look like. That blue line is the IPP, and that yellow line would be your RSPs. So your first year of opening up the account, we're going to have that first time lump sum contribution, and then the annual contributions. You can quickly see how it outpaces the RSP. So in this scenario now, essentially what we're looking at is the first year we've added $145,000 of an extra contribution room. So either we can pull some of the RSP money over, or if that client had existing cash within the corporations, to make that lump sum contributions. But over this next 10 years, we've had a net increase to contributions by about $300,000, which has grown this individual's retirement savings plans by an extra $500,000. So instead of retiring with maybe around 900-ish or so thousand, we're getting close to that 1.5 million mark by utilizing this strategies. So first time contributions, annual contributions start to outpace the RSPs. Second thing, look at a business owner. Say husband and wife, they're in their early 40s here. They're both employed in wife's corporation, been around for 5 years. The business is growing, it's doing well. It started from scratch. Employment income, 150 for wife, 50 for husband, and they already have 160,000 in RSPs. Because they're so young, this graph is going to start to really work. Because again, the IPP can stay open until you're 71. So this person has about 30 years of a contribution window in front of them, plus that initial lump sum first year contribution for this client. But what I really want to highlight with this person is something called the terminal funding. So the little yellow is just the RSP total value contributions of the account when they're 60, 65, and 71. This blue line is the added benefit of incorporating the IPP as part of the overall structures. So again, with the strategies, with the IPP, we would have had an extra $1.65 million of additional investments accumulated by incorporating IPP. But what's crazy is the terminal funding. So say hypothetically, this client is in her 60s now. She wants to sell her business for $5 million. She sells the business for $5 million. And she's now looking at potential tax bill for maybe around $800,000. So instead, if we have the IPP opened up, when we sell the business, we can do a terminal funding and figure out that light blue line, how much you can contribute into the IPP, which will then use that as a tax deduction towards our final bill of the corporations. So when we look at this and say this person sold and we maximize out at 71, we are now able to tax shelter almost $5 million of investments inside her individual pension plan. If she just would have did the RSPs, would have lost about $800,000 towards taxes, and again, missing out on some really effective tax planning. That's how terminal funding can really help out and work. Then the final one I thought I'd mention is just, again, a family-run business. So say mom and pop run this business for a while here, they're in their 60s, they have another 10 years or so before retirement. Their kids have been in this business and they're in their 30s, they're going to take over. So everyone's earning, the T4 income. Mom and dad have about 1.5 million in RSPs, and the kids have another $500,000. So what we can do is, because the kids are part of the business, is actually add all 4 members of the business into one IPP. So when we look at this number, I looked at the parents and we do long-term projections. The parents' final estate bill, if we leave it the way it looks like, it's going to be probably subjected to around $500,000 to maybe about $750,000 of taxes at their death by collapsing the RSPs. If we can open the IPP and start to funnel the money over by doing that initial lump sum contributions, and over the next 10 years, while they're still working the business before they turn 71, incorporate them into this planning structure. So by doing that, again, we give that initial lump sum contribution for the mom and for the kids that we can put into the account. Over this next first 10 years, we're going to allow an extra $1 million of net increases to the contributions of this family plan, this IPP. And as well, we're going to increase the family's overall planning structures now to almost $8 million in tax sheltered investments. So when the parents do retire, they can start drawing money out of this pension plan to pay for their retirement. The money sits there, continues to grow as the kids still operate and run the business. But when mom and dad finally pass away, we just remove the name of the owners off the title of the plan, and now all that money just stays within the family and flows to the kids. So this is part of the overall family planning estate structures that can really add benefit if we think we're going to transition our business to the next of kin. So I've talked for a good 20 minutes. If there's questions right now, again, you can always feel free, ask. We'll look at the chat in a second here, but email me, call me. We can provide a free IPP illustration for you. So what that basically means is that with the work of your accountant, confirm the valuations, have this in your hands within about a day or two, and show you what this plan could look like, and is it going to be a benefit for you? And then as well, how does this fit within your overall wealth planning structures? What is the review like? So again, I'm more than happy to have a conversation after this. I love this planning. It's something that can really add benefits. And if we can help our clients retain more of those hard-earned earnings, and utilizing that tax planning that's been around for over 30 years, we're not breaking any rules or laws or anything. We're just utilizing what's available to you that you might not be aware of. So that's it. Do you want to take over and questions or?
Yeah, so yeah, maybe you want to address this first question. So can a spouse be a director of the corp for an IPP?
Yes. Well, so if a spouse, so as an example, one of my doctor clients I just had recently, his spouse is a non-voting shareholder of the plan, and so we added her onto the plan. So the reason why you want to do this is that if you're paying corporate tax income out as a spouse, this generates contribution rooms for the family and the spouse inside the plan. So for him, instead of just maxing out his contributions, we can actually pull her contributions as well into the plan. So good question. Spouses, director, non-voting shareholder, as long as they're registered as an owner, they can be included.
Awesome. Any other questions that anyone wants to throw in the chat, or even just kind of unmute themselves?
Stop sharing. Yeah.
Don't think so. Stephen, you really well explained. And IPPs aren't a simple topic. So really kudos to you for explaining that in a way that I think most individuals and business owners can really understand.
Sure.
If there's no questions, I'd like to conclude our inaugural podcast. Like I mentioned before, if anyone is interested in talking about anything, it can be business related, it can be what's issues they're facing at work or any challenges that they've seen. Love to have you on at the Gallo LLP podcast, and let's get this started and hopefully build some momentum. So thank you everyone for tuning in, and have yourselves a great weekend.
See you.
Go Bengals.
See you guys.